Hello and welcome to Signals and Noise, where strategists and economists from around the globe offer a shorter take on markets and economic matters as part of global research at BofA. I'm Aditya Bhave, head of US economics research at BofA Securities, and we're recording this episode on Monday, July 20th, 2026. Our base case for Fed policy is 325 basis point hikes this year in September, October, and December. Our reasoning is simple. Relative to 12 months ago, the unemployment rate is roughly flat and core PCE inflation is up around 50 basis points. Yet, the policy rate is 75 basis points lower. This suggests policy is clearly offside, and honestly, you don't need VAR to see that. Even if much of the inflation overshoot is due to one-off factors such as tariffs and the Iran conflict, we still think it makes sense to reverse the 75 basis points of rate cuts from last fall. Client pushback against our call generally falls into three categories. First, some clients believe the Fed shouldn't hike because inflation isn't that much of a problem. This argument has gained traction following the soft June CPI print. Regarding the sharp drop in headline inflation in June, we would note that our call isn't premised on a sustained surge in energy prices. The issue, in our view, is core inflation. And on the core side, we would caution against placing too much emphasis on a single data point. After a series of strong core PCE prints from December through May, it would take several months of softer inflation readings for the underlying trend to appear less concerning. Now, the dovish view is that core PCE inflation, the overshoot in core PCE inflation, is largely the result of one-off supply shocks or data distortions. There is some truth to that argument, but it's important to do the math on underlying inflation. By our estimates, one-off factors such as tariffs and the Iran conflict have added about 80 basis points to the core PCE. So even if those effects were to reverse entirely and no new shocks were to emerge, core PCE inflation would still be running around 2.5%. With labor market risks roughly balanced, that would still call for a restrictive policy stance. And in our view, the current stance of policy is neutral or perhaps even slightly accommodative. As a result, we think further rate hikes are warranted. Another source of pushback to our view is that while the Fed perhaps should hike, it ultimately won't because Chair Warsh is inherently dovish. The argument is that his hawkish rhetoric at the June press conference was intended to build credibility with markets and the more hawkish members of the FOMC. Under this view, he would use the task forces to buy time, but ultimately would stop short of delivering rate hikes. While this is not our base case, we do see it as a highly plausible alternative scenario. Warsh might also be able to point to an expected decline in core PCE inflation driven by revisions and the fading of tariff-related effects from year-over-year inflation as justification for standing pat. The risk, however, is that if markets conclude underlying inflation has not truly subsided, he could lose the credibility he gained through his hawkish tone in June. In that scenario, the yield curve would steepen with long-end break-even inflation reflecting expectations of a more persistent inflation overshoot. In our view, Warsh also is incentivized to act sooner rather than later. If he raises rates this year, he can build credibility with markets without owning the inflation problem, which built up under Powell's tenure. By contrast, if he does not hike this year, he would effectively be betting that hikes will not be necessary next year. Otherwise, he would lose credibility and his Fed would be viewed as behind the curve. Finally, some clients argue that even if the Fed does hike, 75 basis points is too much. In our view, if the Fed begins hiking, it is likely to deliver at least 50 basis points because the federal funds rate is a blunt policy instrument. Markets are currently pricing roughly 45 basis points of hikes at the peak. Therefore, The Fed would need to deliver at least 75 basis points of tightening, roughly the size of a typical mid-cycle adjustment if it wants to tighten financial conditions further. Thanks for listening to Signals and Noise. We'll be back soon with more insights from BofA Global Research.
Bank of America and BofA Securities are the marketing names for the global banking businesses and global markets businesses, which includes BofA Global Research of Bank of America Corporation. Lending, derivatives, and other commercial banking activities are performed globally by banking affiliates of Bank of America Corporation, including Bank of America N.A., member FDIC. Securities, trading, research, strategic advisory, and other investment banking and markets activities are performed globally by affiliates of Bank of America Corporation, including in the United States BofA Securities Inc., a registered broker-dealer and member of FINRA and SIPC, and in other jurisdictions by locally registered entities. Copyright 2026 Bank of America Corporation, all rights reserved.